Secrets to Abundant Living podcast community. Welcome back to the podcast. This is Amy Sylvis, your host. I am the founder and CEO of Sylvis Capital. I want to welcome you back to part 2 of this real estate and economic update webinar that we hosted for our investor club just a couple weeks ago. As mentioned, we've sliced this into 2 different episodes to make sure that it's more easily digestible, that you can really sink your teeth into this information and really learn from the incredible education and experience background that Bruce Fraser and Matt Hock have of Elkhorn Capital. There's a lot of changes going on, as whether it's inflation, whether it's interest rates, tariffs, DOGE, government spending, all of this incredibly important for us to understand as savvy investors. And so I'm excited to welcome you to part 2 of this webinar that we hosted for our investor club. Okay, don't forget to follow Bruce and Matt on LinkedIn. Their information is in the show notes, and I look forward to hearing your feedback on this webinar episode. My investors really loved it. I think you all will as well.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
So let's talk about interest rates, because there's the Fed funds rates, right? Everyone's paying attention to what the Federal Reserve is doing. That doesn't necessarily correlate to the 10-year Treasury, right? For those who don't know, the Fed funds rate is the interest rate in which banks lend each other money overnight. That's not necessarily, oh, the Fed has cut those rates. That means that the next multifamily deal that we do with Bruce and Matt, our interest rate is going to be lower. We hope so, but there is a lot that goes into that. I'd love to hear, given the national debt, given what the Fed is looking at in terms of possible GDP growth, inflation, all of these things, where do you think the Fed funds rate is going in 25?
Well, I'm glad you defined the Fed funds rate so I didn't have to.
Did I do it right, Bruce? Did I get it?
You got it. You nailed it.
Let's go.
Let's talk about the Fed cutting rates. They're not cutting borrowing rates. They're cutting the federal funds rate, which is the rate at which banks borrow overnight, on an unsecured basis, basically. So what we just saw happen, a lot of people were waiting for the Fed to cut rates. They did start cutting, but the rates at which we borrow went up. And that caught a lot of people off guard. Like, well, wait a minute. And you're right. Those borrowing rates are usually pinned to the Treasury yield. And so it depends how long you're borrowing. You borrow 5 years, probably pinned to the 5 year. If you borrow 7, probably pinned to the 7. But 10 years is a very important rate in real estate. And so why did those go up when the Fed cut? Well, I think go back and listen to everything we just discussed. The market out there was not really feeling super happy about all this debt, this debt fire hose, and they wanted to be compensated at a higher rate. And so the bonds were selling off, which caused the yields to go up. So looking forward, what happens? I mean, it's really complex right now because Fed's not necessarily setting rates. And that's what one of the big risks I've always said is, if I look at the U.S. government debt and who is impaired the most by high interest rates, well, it's the federal government. It hurts them worse than anybody because they're the biggest debtor in the world. And so higher for longer is tragic for the balance sheet of the U.S. government. And why they didn't lock in when they could borrow sub 1% at 30 to 50 years, I have no idea. Because then they would have a legitimate argument to say, oh, we can keep it higher for longer and it's not going to hurt us. It's just going to dampen inflation. And that would be very believable. But instead, and when he did, I don't want this to be taken politically, but the facts are, under Clinton, he balanced the budget. Now, how did he do that? They took the average maturity from 20 years down to roughly 2. And so they saved a few basis points on all that debt. And so their interest expense dropped a lot. And by doing that, they balanced the budget. Well, problem is they inserted this massive amount of risk for our country, because some doubts come into the market, rates spike immediately, and our borrowing costs immediately go up instead of being fixed for so long. Just like borrowing for your house purchase. But most likely, if you plan to stay there long term, you probably do fixed rate and lock it in for long term. But that's not, we did the opposite as a country. And so my fear is always, and I've said this to Matt a lot, is that the Fed loses control of setting rates and that the market starts to set rates. Because back to my comment earlier, no one in their right mind would loan the U.S. government money at 4% for 10, 20, 30 years, because inflation most likely is going to be higher than that. Let's say even if CPI was real, which it's not, but let's say CPI is accurate and we're running at 3, 4, 5, 6% based on the recent numbers. If you're getting paid 4, let's just say the inflation rate is 3. So we're getting paid 4 on the Treasury. Well, that 4% you're paying tax on, so you get probably a third of it back. So you're losing purchasing power, even if the inflation numbers are accurate. And so that's not the point of investing. And so the point is to make the number go up. And so demand for the long end of the borrowing is just not there. And a couple of times when the Fed has gone on the market and tried to reissue 10 years for the 10-year slug that just matured, it's crickets. I mean, there's some data that you can monitor to watch the distribution of the interest rates or the prices that are being paid for those treasuries and what that means on the tail risk. And when you see that gap widen, it means that they basically had a failed auction and somebody had to come in and step in and buy in bulk. And that would probably be us, the U.S. government, buying your own stuff. And so the fear is that the market truly starts setting rates themselves. They don't want that to happen because the interest rate would be probably double or higher than what it is now. And so, which would be catastrophic for them. And there'd be a lot of doubt about the viability financially of U.S. government, et cetera. And so what will they do? And what they've done in the past was monetize the debt. And so they just print more money or print more debt to pay off the existing stuff that's maturing. And so it just is this compounding ball of nastiness. But it's very easy to identify when they're doing that. And it's not politically popular, the voters or with other countries that, we still need to buy some of the debt. And so, there was a proposal done by a group called ISDA, and I won't go too deep in this, but I posted about this early last year. So if you're connected to me, go dig it out. The headline was, "Hey, this is really important. Pay attention to this item that's not being discussed." And the proposal was that banks are held to something called SLR, which is their leverage ratio requirement. And for obvious reasons, you don't want banks to be too over levered because bad things happen when there's too much leverage in banks. And so the proposal was that U.S. Treasuries not be counted in that SLR calculation. So they don't count against them for leverage. So what does that create a situation of? Well, they can borrow from the Fed at almost nothing, and then they could get paid 4 or 5% on their money and do it over infinite times because it never will count against their balance sheet. So what does that do? It's complicated, and so most voters don't dig into it long enough to understand what was proposed, but it's a hidden debt monetization because now they have a massive new buyer that has infinite appetite for their debt. That was months ago, and you think, well, it's so esoteric, I doubt it would happen. Well, it was put in place temporarily some time ago, but there was a proposal recently by ISDA to make it permanent. Well, you have to have political support for that. Well, guess what? Michelle Bowman, who is likely the new vice chair of the Fed, hasn't been announced yet, but she's definitely the front runner. She's been recently quoted publicly that says she does support this SLR change in rules where the treasuries don't count against it. And so that could be game changing. I mean, because then that, even though you may not have a Fed that wants to cut rates, they may not have to drive borrowing costs down, because if this proposal gets put in place, all of a sudden there are going to be a ton of big banks out there buying as many treasuries as they can, which will force the price up and the yield down. And that, again, we already pointed out that the treasuries at certain terms are pivotal in what all the banks lend that plus some spread. And so if the treasury rates go down from something like this, then borrowing costs would drop, which is extremely bullish for real estate.
Yes. Great insight, because to your point, I think most people do really just expect or correlate what the Fed funds rate does and for that to trickle down to the rest of us. So understanding that there are different levers and what to look out for. Very, very interesting.
And that's not just unsophisticated people or people
right.
And not that they're unsophisticated, but people that are not paying attention to that economic stuff. Everybody's got their highest and best use. And certainly for most people, it's not to worry about this stuff. But even bankers, I think, were really caught off guard because we are distressed. We're known for distressed situation acquisitions. We're very well capitalized. And so we have banks reach out to us when they are concerned about a property or taking the property back. They reach out to us and say, would you guys be interested in stepping in and helping us with this? But we think that a lot of those conversations had bbeen delayed because everybody knew the Fed was likely to start cutting end of last year. They did. What they weren't expecting was what we just talked about. The borrowing rates actually went up instead of down. And so a lot of these deals where loans might not be performing because the interest rates spiked or they didn't execute a business plan or something, a lot of these banks or lenders had been giving them some time, extend and pretend, as they say.
Yes.
But now I think what we're seeing is risk managers are starting to step in and say, you know what, it went the wrong way. The cuts came, didn't have the result we wanted. So we believe they're going to be an increase in forced sales this year.
Wow. That was definitely one of the topics I wanted to touch on too. Before we hop there, can we just talk a little bit about tariffs? I mean, you alluded to the fact that there are so many moving parts, unprecedented times. How many times have we heard that over the past decade or so? But what are your thoughts on tariffs just macroeconomically and then specifically in the business where you do value add multifamily? What do you see in terms of risk, if any?
Yeah, I mean, it is opaque. It is very complicated because it depends what kind of tariff we're talking about. And from what I've read, both Trump say and his team, things that they've said publicly and done, I really believe that they're complete free market, open-minded. That's what they want. They don't want to be imposing tariffs, but it's being used as a sledgehammer tool to force the behavior they want. And so, what we saw with a couple of countries recently, he implemented these tariffs, and at least in one case, it was less than 24 hours before the country caved and gave him what he wanted. Yeah, it was Mexico, wasn't it? That was first man, I think.
I think so. Yeah. I saw the T-shirt that said, "I survived the Great Trade War of 2020."
Right. And they must have gotten that printed ahead of time. It was in spots in a few hours. And there's so many pundits just hand-wringing over the tariffs and how terrible it's going to be. And what they didn't understand the chess matches being played. And so, and people complain, but I think it's like 1.5% of our GDP comes from Mexico. 35% of theirs comes from us. And so who's got the power? We do. There's no question. Same kind of situation with Canada. Numbers aren't quite as extreme, but they're very extreme. And so to throw your weight around a little bit is honestly, as a country, and it's not one side of the aisle or the other, but there's a long history of us just giving away everything and being taken advantage of. Things like I can't remember the actual official term of it, but the Clean Air Act that was done globally. The biggest polluter is China. They're not participating, but we put all these controls and impositions on ourselves, which was causing a ton of cost and competitive inefficiency. And so it just doesn't make sense when the biggest person at the table isn't at the table. And so why would we subject ourselves to it? So some of it actually makes sense. It may not be, we all want a greener world, but it hasn't always been executed the right way. And I think on the tariffs, it's a great example. And this week, I think it was, or maybe sometime in the last week, there was a whole list of what's called reciprocal tariffs proposed. And what that means is, let's say country A is charging 20% on everything that comes in from the US, but we don't charge anything to them. Well, that's silly. And so why would we allow that? And so what reciprocal tariffs are is to try to force that out where it says, okay, you're going to charge us 20, we're going to charge 20. And hopefully, I think what the end game is to not have any tariffs where those get taken away. And because who knows day to day what some of the administration says, but I have seen where they say we should fund all revenue from tariffs. I don't know. That is a different path than what I'm seeing so far. What I'm seeing so far is they're using it to try to make it a more fair trade world.
That makes sense. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show.
I think that that's a really good macro outlook. And I think from a micro look on how we would deal with it is, we purchase a lot of supplies. We're a big buyer from Home Depot or the other agencies up in Oklahoma. And I think what that's going to force us to do is if there's going to be a lot more tariffs on things that we purchase, it's going to force us essentially to take a lot of this stuff in-house. And rather than go to a third party to buy stuff where they're going to pass that along, we may just purchase a container of flooring directly from China, which is the same thing that Home Depot or whatever base hardware, they're purchasing that as well. But we're going to cut out that margin that they're taking and essentially do it on our own, which in the long run is going to put us in a better position as we continue to build out our organization. In the short run, it's going to be painful to put those different steps in place, but it'll allow us to keep our costs the same and just cut out the middleman. Now, if we had already had that in place for some stuff, it may be a little bit more painful, but I think from an organization that's our size, we're going to be able to manage that appropriately.
That's a great point. And due to the scale that we have in being known by so many people, there was actually a situation where we were able to do something like this, but it wasn't from going direct to China or whoever the producing country is. We had a third-party management company that was failing. They had a building supply unit. Well, they contacted us because they know, again, we need the product and we're well capitalized. And they said, hey, would you guys be interested in buying any of this product? Well, they sent us an Excel sheet and they didn't know we knew how to open up the unlocked part or the locked part. And we could see exactly what their cost was from China. And that's what we offered them. Like, we'll pay all this for you. And all of a sudden we have 18 wheelers of supply coming up to our markets. And we still have a bunch of that stuff that was bought just dirt cheap. I mean, just pennies on the dollar. Flooring for, I think it was like 30 cents a foot. And we have all kinds of tile backsplash that, now, because the cost price was so much lower, we could probably put that in some properties that we might not normally would have done and still get a return on our money. So it's very real. It adds another potential power if you do go direct. Now, this also adds complicating factors, but there are different things that in lieu of having one property, a bunch of different markets, which is how I saw originally coming from the equity markets. I thought, I want to be diversified across a bunch of areas. But what we found was there's so much more power in being concentrated in a handful of markets. People know you, potential employees know you, you have power with your vendors, lenders view you as an expert. I mean, there's a big event that I'm sure in MHC and a lot of people go. People always ask us, are you going? Like, we don't have any need to go. The reason to go is to meet a bunch of brokers. We know all the brokers in our market and you know us. And so people ask us where we get deals. Like, we answer the phone. Usually that's how we get them. And so it makes a big difference. It really does.
I love that you mentioned risk is inevitable in this business as an investor, but how do we mitigate that risk? What are the tools in our tool belt? As you all mentioned, anticipating, following the data, bulk purchasing, being heavy in a market, being expert. I talk to a lot of investors who are just learning this kind of concept of economies of scale. And one of the benefits of, maybe you're in California, maybe you're in New York, you want the benefit of investing in real estate. You think maybe I'll buy a single family home or a condo, but understanding this perspective of why investing in a large commercial real estate deal or several with an experienced firm like you all might be beneficial. Those economies of scale, especially when you're trying to mitigate some of these risks, can be quite beneficial. So that's a bit of a broad stroke, but I do think
that's not a bad thing to do when you're doing a single family rental. But
of course,
unless it's a whole portfolio that's being run institutionally, typically I see people max out at about 10. Yes. And what you find is it's probably some in the corporate world. They're not super happy. They want a different path. They read about passive income from real estate and they can't afford to go buy a complex on their own. So they find a single family house. The problem is they barely cash flow. And even if done right, there's not much net there. And they add a second one from your successor or a third one. And what they've actually done is they haven't free themselves of the shackles of the corporate world. They just created a second job for themselves. And it becomes quite the burden. And so, yeah, investing in deals like this, either the way we do it directly or as an LP, it doesn't take any of your time, and you arguably have a lower risk as well. So it's a good way to do it.
So let's dive a little bit in the last, I can't believe how quickly the time has gone, the last kind of 10 minutes here, and focusing on commercial real estate, all of our areas of expertise here. We're looking at changes in possibly rent growth, construction, apartment demand, distressed debt that you alluded to. Maybe let's start there. Bruce, you mentioned some of this kick the can down the road, some of these distressed deals that maybe lenders were hoping interest rates might help take care of those deals. And it sounds like some of the risk folks are saying, it looks like we're going to have to actually deal with these instead of just hoping things get better via the Fed. Are you seeing quite a bit of distress currently? Are you anticipating it coming? What does that look like?
Yeah. So let me start a little bit higher level, then I'll dive into that. But
Please.
I mean, I'm an economics guy. So to me, everything's about supply and demand.
Yeah.
Everything about pricing is supply and demand. And so we're very thoughtful and very quantitative, of course, about the markets that we invest in. We want it to be a strong economy that's growing, job growth, population growth, have been low unemployment, because if they're unemployed, they're probably not a good tenant. You want all these things, but you also have to look at the supply, because that's all demand stuff. And so if you're net recipient of all of this population migration that we've seen going on the last few years, and I know you're of this mindset too, California is a beautiful place. I wouldn't want to own property there.
No shot.
Commercial property, because there's just too many rules. It's too difficult, and the population's moving away. And so that means on pricing, what I'm going to do, I'm going to have to cut my real rents. And so that's problematic. But I remember a lender that had not loaned in Tulsa before wanted to come see a property that they were going to do or potentially do a loan on. And I flew up there and met him, and we had breakfast. I remember breakfast, he's like, "Why do you like Tulsa?" And I started going through all of the data as to why, all numbers-based stuff, including the fact that where we invest is usually workforce housing, and supply is going down, not up, but yet the population and the jobs for that category are increasing, and it's just nowhere for them to live. What's that result in? Double-digit rent growth year after year. And so it's not rocket science. You just have to do the work. And some places are sexy. I'm not going to step on any toes here, but those are good deals in all these markets. Well, I won't list town names, but there's some very trending markets here in Texas that it would be great to discuss and say, hey, I'm buying an asset here. But the reality is the rents have already gone up so much in some of those markets. It drew all this additional supply coming in. And so if you even have a 2-year-old building, well, you know what? It's not going to be as nice as the brand new one.
Right.
And so you're not going to be able to get the rent growth you want. The other thing is affordability. And we look at that as well, because we're heavy in Tulsa and Oklahoma City. But if you look at what people spend on housing versus national average, is well below the national average. So we know that we can increase rents and they can still afford it. Now, they may not be thrilled with it, but they can afford it. And if you look at some of the markets like this particular sexy markets out in Texas, there isn't any affordability. People, I mean, my daughter lived in one of these towns, and she's like, "Dad, I'm gonna have to move. I see what they're doing rents for. I literally just can't afford it." And so people either have to trade down or move towns. And so that's swimming against the tide, like I was talking about, and that's not the way we like to do it. So that translates into distress, and which was your actual question. And we're seeing a lot of distress in some of the markets we frankly wouldn't own in, even if it's quote discounted. Like, we don't want to own there. It's too hard to own there long term. And so, but we will look at stuff in markets we're already in for sure. And there's a lot of distress out there. I honestly don't know of another operator that was 100% fixed rate going into these rate hikes. And so everybody's had pain on at least one deal, if not all of their deals. And so whether that culminates in them losing the asset or capital calls, there'll be some combination thereof. Some of the deals still work. They get a little bit more fresh capital, and their business plan's working. They just need more money to invest and change more units or something like that. We've looked at some of those for investors that are in other operators' deals. And some of them, it makes sense. And some of them are just trying to buy a year. And like, well, so you're betting, you're putting more chips on the table that it's just going to resolve and rates are going to be lower in a year. That's a high risk one. So they're out there. It's pervasive. It's just, what does it result in? Will a lot of assets be taken back? I think the first wave are the assets that are not attractive. We have a lender that came to us on 2 assets, and it's a market we like, but the assets are terrible. And really aren't buyers for that kind of asset, other than us and maybe one or two other groups. And so before Bank was like, well, what are you guys worried? I'm like, well, I'm not going to spend the time to do that until you're physically on that property and you walk in, and then you call me.
Yeah. Yeah.
We're in terrible condition. And we know that because we have a presence there. I mean, a broker can call us about a deal. We can have someone walk the secret shopping that property or driving it and taking pictures in less than an hour. And so it's just powerful to be able to move quickly like that and be responsive to these lenders, having a reputation we do, that we always do what we say we're going to do, and then close when we say we're going to close, and all those things. That's very important for a lender because they don't want to try to sell an asset that's on their balance sheet and then them have to go find another new buyer when that guy can't execute. So
what I love that you point out, Bruce, and for those who aren't familiar with commercial real estate, is unlike single family, a lot of these deals that make sense aren't necessarily available to the general public. There isn't some MLS you can go on. I mean, commercial properties are available in that way, but what Bruce and Matt are able to do and what can be so advantageous in this commercial real estate game is having these relationships, whether it's direct to seller or in their case, to lenders. That's where you get the deals where the cost basis is incredible that no one else has access to. You are in some sort of bidding war where, yes, you win the deal, but you're overpaying because you're competing against a whole host of other people. This is one of the big secrets of this game and why partnering with great folks like Elkhorn is so important, because they have this reputation and these access to these investments that the general public just doesn't. So I love that you mentioned, is there distress? What is coming across your desk? And you're able to pick and choose what fits, what works, and then thus have those great deals for investors.
Yeah. I mean, there are kind of two things I'd like to add on to that. One is just our firm's reputation with other counterparties. Honest. I mean, a lot of times a seller sells to a buyer, and that buyer learns all kinds of things that weren't disclosed. The numbers weren't really the numbers, or there were repairs that were needed that weren't discovered during the due diligence process, all kinds of things like that. And that's probably more common than not. And I think that our two most recent sales, I still communicate with those principals, and they still want to do more business with us because we're all cards on the table. Like, listen, if I'm buying this asset, you need to put a roof on it. If your ownership period is more than a couple of years, you're going to have to plan to put a roof on it. Please put that in your CapEx. And we're just full disclosure of what we see if we were looking at the new asset. And I think that's a breath of fresh air for some of these people. And we've really built good relationships with some of them. And they trust you more when they're a buyer of one of your assets. Then they'll call you again and say, hey, you have anything? Because if we're bringing something that's heavily distressed to a point where a normal value add buyer would buy it, well, we're okay sometimes selling it to somebody else who would take it if it wasn't an asset we wanted to have long term. Mm. What we found in a couple of deals, and you were involved in one of them recently, was some of these assets we went into knowing it was a heavy lift turnaround. We got it turned around and it's running so well, we already want to sell it. And so there's always a mix. There was the ones that you thought would be easy and they weren't too, but the one in particular that you were involved in, it was that situation. It was a foreclosure. We bought it from Freddie Mac. It had been doing about $45K in revenue a month when we took over. Now it's doing, I think, Matt, you probably know, but
just shy of 200,
right at $200,000 a month. And it's a very nicely cash flowing property. Well, why would we hand that off to somebody else when we still see a lot of incremental upside and have proven it already on half the units or something? So what we did was we recapitalized it, which can have a negative connotation, but this was a good recap where we just said to our existing partners, because we told them, we promised them a liquidity window when we sold. And so we wanted them hold true to our word and offer that. And so we offered existing partners the ability to exit and new partners to come into that opportunity. And one of them in particular, I think over 80% of the money wanted to stay in. We had to actually force some people to reduce so that we had room for some of the new people. But we have an opportunity like that that's potentially that we're working on. It's one in our portfolios of foreclosure we bought too, that we're still digging in and seeing if it works that way too. But it's one of those assets that we really like, and we like, but it, we've had it for a few years and we've turned it around now. And so it's a different bucket of money for investors, the ones that wanted to go in and do the heavy lift with this, and then the ones that just want income off of it. But, so there will be opportunities coming up that aren't even necessarily distressed, but we're anxious about the distress too. And we're believers so much that it's going to be forthcoming. We're actually in the process of hiring another person to the team to help us underwrite more deals because we expect that's going to be a need.
Preparing. That's fantastic. Well, I know we're at the the top here, I'd love to give you all just an opportunity to say any final words before I summarize. But yeah, I really appreciate you both being here. Any final thoughts?
I was just thinking about all the notes that I put together for this call, but Bruce just knocked it out of the park with all of his economic analysis. But I think it is important to, if you are looking at investments, to just make sure that you're going into a market that fundamentally makes sense. And I mean, that's why we swim in the Oklahoma market. We really like Oklahoma City and Tulsa because job growth is still growing there, but they're not doing any construction. So that puts us in a great position to take advantage of a lot of people looking for places to live. Whereas in other markets, you just aren't seeing that. And so it's just really important to understand and just have that knowledge about what's actually going on in the area. And just buying right is just so important. I mean, you can do a great job of managing, which I feel like we do, but I think it's also just going in and getting it at the right price and making sure you're in the right area.
Yeah, it's a great point. I mean, as successful as we've been in Oklahoma City, for example, you would think that I would love going there and spending so much time there. And it's, hopefully not hurting anybody's feelings, but I still don't. It would not, I'd much rather be going to Jacksonville, Florida, or somewhere like that. That's more fun to visit, but we're led by the data and where the opportunities are, and that's what we do. And so Matt did a great job of putting a bow on that. But I mean, my final comments would be the same as my posts on LinkedIn, and just position accordingly for all this information that politicians, no matter which side of the aisle they're on, they're going to spin things positively, but dig in and look at the numbers or follow some people that do, and that'll keep you from getting, being on the wrong side of everything.
Brilliant. And thank you both so much for digging into this thesis of where is inflation going? What do we have to think about in terms of preserving our purchasing power, let alone growing our wealth? How are hard assets performing historically? How have they performed in times of inflation? What can you do to protect yourself as you look through what may be coming in what seems like a volatile time? But if we can distill down and really understand what's going on with the noise, we can let the data lead us to successful investments. I will end this by saying we're hoping to maybe have an investment opportunity at some point. I see some names here in the chat that have been knocking down my door, looking for an investment, which I love, looking to deploy capital for these exact reasons. So please stay tuned. We'll definitely let you know if and when we have an opportunity for you, hopefully sooner rather than later. But thank you all again. Bruce, Matt, you all are amazing. Really appreciate your time today.
Thanks, Amy.
Thanks, Amy.
Thanks, everyone. Bye for now.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.